3, 2, 1.
Actually, we were doing the advantages and the disadvantages of floating and fixed exchange rates. This is back when I was 17 years old. And I took economics in my high school in the IB, the International Baccalaureate. And from then on, and then I said, do I want to be an economist in school? So as a bachelor's, I took business. But then when I went to my master's, I started getting idea to this thing, Jeff, that is not very well known, and it's called central banking. You know, the Plaza Accord, the Louvre Accord, central bank interventions. Do they work? Mm-hmm. Who are these people who are closely veiled and closely guarded? And then at the end of the, you know, because they impact the price of money, and that is interest rates. So flashing forward or fast forwarding to, you know, 2001 and 2002, you know, when the dollar reached its 17-year highs in February 2002, when the dollar started going officially into its bear market, when commodities started to push higher, or gold and oil, you start seeing these relationships. At the end of the day, and here's what I want people to know, one of the things that I want them to know, currency markets, there's many players in the field. And what you want to know, you want to buy always the weakest player. I mean, buy the strongest player versus the weakest player. You have the Aussie, you have the Canadian, you have the New Zealand. Yes, they are commodity currencies. You have the lower yielding currencies. You have the dollar, you have the yen, and you have those in between. And sometimes the clue is not always in the currency itself. Sometimes you get the clue from the stock market. Sometimes you get it in the relationship between gold and oil. Sometimes you get it in the yield curves. And that's what my book, Currency Trading and Intermarket Analysis, that's why it is really, I wouldn't say the first, it's the second book after John Murphy's Intermarket Analysis. It's really the second book that really delves deep into this, but from the idea of currency markets and how you can make money in it by looking at the yield curves, looking at the steepness of the yield curves, looking at valuing gold in different currencies, and looking at equity indices. And, you know, I think this is a very long answer, but I'm sure hopefully you're going to do some editing.
No, it's really good.
When I was writing this book, I was approached by Wiley in 2002, and they told me, hey, Ashraf, would you like to write a book about the mechanics of currency trading? And I said, wow, I'm very excited. I got approached to write a book. This is great. We wrote the agreement. We wrote the outline. And then I said to myself, what is this? You know, this is 2002. I'm already doing stuff on intermarket analysis. I've got people coming to my seminars. I don't have to write a book on the mechanics. I don't have the patience. So I let other people write books about the mechanics. And I don't have the patience to write a book saying what is a currency pair. Again, don't get me wrong. I'm not talking down or looking down at the beginners, but I don't have the patience to do that. So because I want to give something more, if I'm going to give so much of my time in writing a book. And finally, you know, in 2007, in summer 07, I started writing this book. And when I started writing this book, Jeff, I was looking at, well, how do I look at equity markets and equity indices, and how do I forecast what central banks are going to do? Because once you know what central banks are going to do, once you know when the interest rate cycle is going to turn, you can do so much in currencies and in equities. I'll give you this example, Jeff. I'll give you this example. If you were to tell me, Ashraf, my crystal ball, and it never failed, it tells me that tomorrow the Dow is going down by 300 points. Ashraf, I am giving you this, and I am giving you money, and I want you to make money with that knowledge, with that fact, or with that prediction, but not in the stock market. I want you to take advantage of that notion or that prediction in the currency market. I could go into 4 or 5 different pairs, currency pairs, euro dollar, euro yen, sterling yen, Aussie dollar. That's each one is a pair, in making money with that knowledge.
Yeah.
And when I was writing that book, Summer '07, I was, well, not only that, but in summer '07, I'm becoming more and more convinced that the Federal Reserve was going to be forced to cut interest rates in summer to fall '07. And as a result, the stock market would start to fall, and the yen would go up, and the dollar would go up. And that's what happened. The Fed actually started to cut rates in August '07 with a discount rate.
Yeah.
With that knowledge, I was so sure with that knowledge, with that confidence, I was going on TV arguing against economists and strategists from other banks, telling them why I think the Fed is going to raise rates, but other people telling us the fundamentals are sound, liquidity is plentiful, private equity moves are going up, the Fed is not going to. Bernanke himself was telling us we are worried about inflation. And I will show you some clips of some interviews, for instance, on April '07, I was on CNBC telling Becky Quick of CNBC and telling her the following, telling her, Becky, I think the Fed is going to raise rates, is going to cut rates this summer '07. And she was saying, oh, Ashraf, I think you're going out on a limb. I said, call it going out on a limb, call it going out on a leg, on a head. But I'm sure that it's going to do that. And people working with me said, Ashraf, these are very strong calls.
Yeah.
But I don't only tell you, okay, I think they're going to cut rates. It's what to do with it. And yes, I was able to get to be number one on FX forecast with Reuters, with FX Week. So there is a way. So the idea is not only to predict, but to say, so what in the currency market? And that's a challenge.